I have a special guest today, Michael Green, who's been a student of the markets and market structure for over 30 years and has talked to every institution in the world, basically the Federal Reserve, the BIS, the IMF, other industry groups, does speaking tours, etc. And what's interesting about this is, Mike, is that you interviewed me. I just went back in 2021 for Real Vision, so I get to kind of turn the tables on you. So let's start kind of with your history. You're a serial tweeter or Xer, or whatever it's called at this point. And sometimes people can confuse the point you want to get across with sarcasm, but for the people that know you and love you, they get the point every time that you write something, and it's always meaning kind of behind it. Let's start with what kind of shaped you in 1987, because you and I are 1 year apart, so it kind of had an impact on both. Let's talk about that and then move forward. And I want to go through this chronicle and hit a few of the data points in each place you were at. So.
Yeah, I mean, 1987 is one of those events that I don't think I'd actually be in the stock market had it not been for that. And of course, paradoxically, the movie Wall Street, which was meant to be a cautionary tale, and I think any 16 or 17-year-old boy basically looked at in the same way they look at the Wolf of Wall Street today, and they're like, "That's me. I want to be that guy." In 1987, I had started doing a lot of work in the stock market. I actually had thought about skipping the end of high school and going to study physics in the University of California system. Ultimately decided I was much more interested in finance and applying myself in a different way. So I ended up applying to Wharton. That, of course, meant that I had to be focused on the stock market. And in 1987, as the events of the crash of 87 were actually beginning to transpire, I was able to convince my parents to let me stay home from school, a la Ferris Bueller, and watch the crash of 1987 from home. Super interesting. Really a formative experience for me, and basically taught me, one of the key things I always remind people, which is markets are all about what you're forced to do, not what you want to do. And that has really been a defining feature of how I kind of approach markets and understanding both the world and the behavior of the little flashing dots on the screen.
Let's fast forward a little bit, and you're being very modest there, I know, because you are a student of financial history as well. I know you read up on it. We'll get into that in a minute. But our group, obviously, at Front Point was involved in the big short trade, so to speak. But you also were. You were short in the ABX while you were at Canyon Partners in 2006, I believe. Talk a little bit about that and what you saw, obviously, at the same time of what we saw.
Well, I mean, the most amazing thing to me was actually that we ended up doing really well on a trade that we got totally wrong. So unlike you guys who were very intentional in it, I was fairly negative on the housing market. Had joined Canyon Partners in early 2006 from Royce and Associates. Whitney George, who was a kind of a legendary PM at Royce in the small cap space, has since gone on to Sprott, where he runs a lot of the gold trust operations. Had kind of inculcated in me an understanding of what was transpiring in the housing market. I brought that over to Canyon Partners, but we largely expressed it in reducing positions in land banks, in taking exposures short a couple of securities. And then one of the other analysts, a young, very talented rising PM, was super enthusiastic about following Carl Icahn into an investment at WCI Communities. And I looked at this. It was like, wait a second here. This is the antithesis of everything we're talking about, right? These are high value Florida condos built under a construction budget in which you're presuming that nobody's going to walk away from $200,000 down payments on $4 million, condos. Like this is insane that you actually are thinking this. And as we kind of went through it, I said, look, my argument is that we should be shorting this whole space. But if you want to buy this position, I will accede to it if we decide, if we will put on this trade, the ABX. And so we scaled our position in the ABX to offset a potential $200 million loss in a complete wipeout on WCI. That meant that we basically figured on that scenario, the ABX would trade down to about 95 cents. So we needed to make $200 million at 95 cents. And that worked out to a notional exposure of somewhere in the neighborhood of $1.5 billion, which, all of a sudden becomes a much bigger number when it trades down to 63, 65, right? And so we ended up making a ton of money in the trade on a completely unintentional manner. We basically made 7 times as much as we lost in the equity position that we were trying to hedge. I think the vast majority of people, that's more indicative of the trade and how it played out than the, kind of thoughtful masterminding that you guys did at Front Point.
I was going to say I had Ivy Zellman on the podcast about a month ago, and she told the WCI story of how she had a short on it, how the CEO approached her at a conference she was speaking at. So I would imagine you guys weren't paying Ivy the correct amount of money at the time, or your analyst wasn't listening to what Ivy was saying at the time. But I know you obviously listener.
Yeah, actually, you'll laugh about this, but so we paid quite a bit to Ivy. In 1999, I was one of the lone people who went to Ivy's Furniture and Housing Conference in the attic at 11 Madison Avenue, the old Credit Suisse building, and like nobody was there. It was totally empty, which of course helped me understand that there was opportunity in home builders in 1999. What was super interesting about how everyone was modeling home builders at that time, you have to remember this, Danny, was that nobody was projecting them to lose money. Right. It was all a question of like, well, they'll have lower gross margins, right? Their earnings will be down, but nobody actually saw that these things were going to lose money, or in some cases like Ovania and others and WCI communities just go absolutely bankrupt.
Well, as you know, home prices never go down. That was the thesis of Moody's with S&P, but we'll get to that. And I promise I want to get to your thoughts about what's going on currently, but I think it's important to walk through what shaped you. So from there, you go to Soros, where Scott Bessent, who's CIO, siege your fund, right, called Ice Farm, and talk about that a little bit, what that experience was like. And I know that you did well, but you were a casualty of what they called the Soros bloodbath, when they basically pulled all the money from all their funds.
Yeah. So the Soros bloodbath very quickly is when Scott Bessent left Soros to go start Key Square. Obviously, very happy for him that he was able to do that and the opportunity that created for him. Soros, like most organizations, is a very political organization, and so the minute Scott left, basically anyone that Scott had touched, the organization coalesced to basically kick them out, right? And so I think I was one of about 14 hedge funds that had been seeded by Soros in that time period that was basically forced to shut their doors within a couple of months of Scott's departure. And as I said, I harbor no ill will. It was an amazing learning experience across a wide variety of dimensions. Anyone who has been in this business and has not actually tried to run their own business really only understands, I would argue, about 25% of what the process of investing as a professional really is all about.
So another character, Peter Thiel, you went to run his family office after Soros, and you spotted something really interesting in the market, because not only are you a student of the markets, you're a student of market structure. And we're going to get into the whole active versus passive argument that I obviously adhere to what you always talk about and the impact that passives had. But you found a really interesting loophole as it relates to the banks and their idea of continuously selling volatility in a product known as the XIV, I believe is what it was. Talk about that. And you had a huge score on that. And again, I promise I'm going to get your thoughts. It's all going to come together here, Kern, but I think it's really important to talk about it.
Okay, so on the XIV, this was actually an outgrowth of the early work that I began to do around passive. And I would just highlight for people that Peter Thiel is famous for meeting people. We had actually met back in 2012 and then again in 2014. In 2016, I met with him and he asked me a really simple question that he asked a lot of people he's trying to hire or get involved with. What do you believe to be true that nobody else believes is true? Or what do you believe to be false that everybody else believes to be true? And I presented to him the early work that I was doing around passive and highlighted that there were various areas of the market in which passive, or more accurately, systematic strategies had become so large that they created extraordinary fragility. I highlighted the inverse VIX complex for him, which was even more passive, actually by a wide margin at that point, significantly more passive still than we have today in terms of the US equity markets, although it's getting closer. The roughly 70% of the volume in the UX futures, which is the VIX futures, which is the replicating underlying for those products, was occurring in just pure systematic strategies and the rebalancing of the levered and inverse versions of those various ETFs. That created a situation in which we could do a predictable event market impact study around what would happen if a level of trading activity needed to occur that could potentially overwhelm the buy side or the reverse, right? Creating a cascading event. And we were really surprised to discover that it was actually a remarkably small number. And so we determined that there was roughly a 95% probability that the XIV itself would go to zero on a 4% decline in the S&P 500. The probability of a single day 4% decline in the S&P 500 is somewhere in the neighborhood of 5% any given month, but over the course of an extended 2-year period, it amps up to somewhere in the neighborhood of roughly 95%. The pricing for that was in the neighborhood of 3%. And that spread between 3 and 95% created an opportunity. We were able to position ourselves in options that are very similar in a lot of ways to the ABX trade that you did, just these kind of tail options that sit out there. And when the product predictably blew up on a 4% decline in the S&P on February 5th, 2018, we did quite well. What's super interesting about that, just to finish, and I promise I'll take a breath after this, is that the precipitating action was not something endogenous to the market itself. It wasn't simply that like the market had to do this. What actually happened was on February 2nd, 2018, the Federal Reserve changed what's called their CCAR provision, their capital adequacy ratio provisions. That dramatically raised the capital cost of being short volatility. There was an arbitrage that existed that was introduced in the aftermath of the Volcker rule. If your clients were long equities, you needed to hold capital against that position. That accounted for an instantaneous crash of 1987 style event, just to bring us back to that. So a 30% roughly instantaneous decline in the S&P. The equivalent capital charge for being short volatility was a 10-point jump in the VIX. Those two are not the same by any possible imagining. That actually created conditions where it was far more profitable for the street to express client positions as short volatility as compared to being long S&P futures. They took the basis risk associated with that. And when that began to unwind, like on that Friday going into that Monday, because my positioning was known, I started getting all sorts of phone calls from banks saying, like, would you lend to us capped variance at, X price? No. Why are you calling, right? What's going on? And by the end of the day on Monday, like we were getting quotes where people were willing to pay a 75% annualized rate of return in investment grade debt equivalent to cover some of the exposures that were out there. So the far more interesting trade was created by the positioning we had going into it.
Yeah, it's really interesting. And I think it was at least cited that the firm made $244 million in that trade. And because you're a student of passive, and that was an ETN, right? An electronically traded note versus electronically traded fund or an ETF. Fast forward to today at Simplify, which have threaded the needle, right? There's active and there's passive, and then there's actively managed ETFs. And Simplify was born out of a rule change that allowed derivatives to be used in this form. And I know you're a chief strategist there and a portfolio manager of a few products there. Talk a little bit about how Simplify sits there and how it's the culmination of kind of everything you see that is wrong about passive and right about active.
Well, the answer is, of course, that there is not everything wrong with passive. There's not everything right with active. I think we have to give credit to critics in both camps. I really do actually think that's important. The key thing in passive is that it is not passive. So we use this language for it. It is a remarkable marketing coup to be called passive. Nobody wants to go home and tell their wife, I got my butt kicked by a bunch of passive indices, right? That makes you sound even worse than you actually are. But what passive is you could gather from my discussion around XIV, it is just a systematic algorithmic decision process. Passive is it's implemented in the United States, which is largely market cap weighted or float adjusted market cap weighted buying of all stocks in the indices, usually the S&P 500, but often things like a total market index. That is really just an algorithm that says, did you give me cash? If so, then buy. Did you ask for cash? If so, then sell. There is no question, is it a good time to buy? Is it a bad time to buy, right? Do I face exigent circumstances in the near future that should cause me to change my allocations, et cetera? None of that occurs in the process of passive investing. Instead, what it does is it adds more money to things that went up, and that reinforces a momentum framework. There is a second component that's super pernicious about it, which is this idea that the active managers are actually on net getting sold because they ostensibly stink at their jobs. That's actually not really true. So one, there is actually incredible evidence that within the funds, the decisions that are made by active managers add a tremendous amount of value. The second thing, though, that's interesting about that is that the choices that are made for them, shareholders adding capital, shareholders redeeming capital from funds, actually subtracts an incredible amount of value. And it makes perfect sense. Nobody wants to give money to an underperforming manager, even as their cycle may turn. Everybody wants to give money to an outperforming manager because they think they're absolutely geniuses. As a result, it tends to amplify their effects in both directions, making it much, much harder to perform and certainly leading to somewhat confusing metrics. At Simplify, we do something very, very simple. We try to take underlying beta exposures. For example, I run a high yield fund. So the Simplify high yield fund accesses the high yield signature by using a total return swap to buy high yield exposure. The reason we do that is because the ETFs in high yield that are very popular, things like HYG, are often used by active bond funds to X out their market exposure. Their shorting that creates pressure on dealer balance sheets. By taking the total return swap long through that, I'm actually picking up an additional funding mechanism benefit from that relationship. The dealer is paying me to take the high yield exposure from them. We then modify it further by adding a credit hedge overlay. We use a couple of different tools for that, but the most important one is a proprietary, what I call quality junk overlay, that goes long quality equities and short junk equities weighted in proportion to the high yield indices. So I'm not doing an equity exposure. I'm really looking for a sectoral exposure in the high yield space. Doing that takes advantage of a theoretical framework in in financial theory, the capital structure under a Merton model. We're effectively going long companies that don't need to access the capital markets, and we're going short companies that need to continually access the capital markets. When credit spreads spike, that tells you it's very hard for companies to get access to capital markets. Those companies that need it desperately fall faster. And so it creates actually a positive carry hedge that allows us to offset the credit risk, which is the primary risk in high yield, without paying the penalty associated with hedging. Those are ways of thinking about like what's the good side and what's the bad side of both. The really key thing that I always try to emphasize is we want to see people who don't have the resources to figure out investments, don't really know what they should be doing to have access to passive investing. I think it is absolutely insane that people who have incredible resources, and I would include pension plans, I would include sovereign wealth funds, I would include ultra high net worth individuals. I think it's really terrifying that we have, as a society, have said, man, I can't add any value in allocating capital, because that's really what markets are all about. And as a result, I think that, it's important to raise awareness of the challenges that are being created by passive dominance and highlight the active stuff, while at the same time recognizing you can make mistakes in active, you can be unethical in active, you can charge too high fees in active, et cetera.
It's interesting. You have always cited kind of 2012 to 2016 is really the explosion of passive. And after Front Point, Vincent Daniel Porter Collins and myself left to start Seawolf, we literally launched in January 2012 and ended it at the end of 2016. And we're value guys, right? We're bottom up stock pickers. And we did fine, but we were always fighting kind of those tides. And I try to explain to people what I believe are two things that have occurred over the last 20 years. Obviously, a lot of money being pumped into the system. Federal Reserve coming to bail us out, 3, 1, 2, 3, 4, soon to be 5. We're going to get into that, I promise. And one of the things is that I believe the way that retail brokers ended up changing the way that they're compensated was to move to ETFs and charge a management fee as to picking stocks, because that's how they were compensated. They changed. And I think that kind of self-fulfilled this. The other thing, Michael, and I'd love to get your thoughts on this, is as an active manager, it's been really tough, to your point, to beat passive, because you're just fighting flows and you're fighting a formula, whether it's erroneous formula or not. It's the formula that when money comes in, it's allocated to X stock, Y stock, Z stock. It's the job of the portfolio manager at Fidelity, not just to pick out what sector he wants to overweight, underweight, but what stocks within those sectors. So that game, at least for a long period of time, proved fruitless in the sense of you're better off knowing where the flows are coming from than what these companies do. And it feels like things are changing in real time right now. And stock picking for the last kind of 2 to 3 years has come back to the forefront. So it's really interesting when you talk about Simplify, and no pun intended, you made that sound simple. And I'm amazed at how low the fees are I think like 0.75% relative to putting on these swaps and stuff with these dealers. It seems like it would be a lot more expensive than what you're doing. So kudos to you guys on doing that. But kind of talk to me a little bit about how market dislocations, and now we're going to bring it to right now, present day, pays to understand market structure, stock picking, bottom up valuation, both in credit and equities right now, and how invaluable that is at a time like this.
The really key thing that you hit on is you identified this issue of flows. And what people don't understand about passive investing is it's not about buying everything in proportion to the stock market. It's actually about that observation that you're buying anything at all. By definition, that means you're not passive. And so then it becomes a question of how frictional is the impact of your buying activity. Buying on a market cap weighted basis seems like it should be relatively non-frictional, right? You're spending more money to buy the largest companies, you're spending less money to buy the smallest companies, therefore your impact should roughly scale. The problem is that liquidity does not scale with market capitalization. And as a result, if you just think about what liquidity or your ability to absorb flow is a function of, it's a function of volume and volatility. And the largest companies can be 100 times larger than the smallest companies. They typically will trade between 5 and 10 times as much. So you can immediately see how you get this impact. The other thing to remember is that the ability to substitute the largest companies is impossible, right? So elasticity is the economic term of how prices react to changes in supply and demand. The more something cannot be substituted, the less elastic its response is, the more its price will change in response to changes in supply and demand. The largest companies are almost perfectly inelastic in an index-dominated world. The chart that I'm showing you is the really critical one for people to understand, which is that as passive flows have grown, that was totally fine until just about 2014, 2015, January 2016, Danny, when you guys we're kind of starting to face real challenges, I would guess. What was actually happening is that the active manager signal was turning negative. So if you think about flow as your ability to put capital towards your ideas, as new capital comes in, that gives you an increasing voice in the market. As your capital starts to leave, it paradoxically forces you to undo what you have already done. And your next marginal trade is weaker and weaker conviction as you lose your asset base. And so what's really transpired in the market is that since 2003, 2004, the share of trading that is fundamental in nature, the type of stuff you would do as a value investor, has collapsed to less than 10% of the trading activity. The flows have turned negative, meaning there is a negative loading associated with this value signal that you were employing because you were thoughtful like all the other active managers. And I'm using that not in a positive judgment. I'm actually being somewhat ironic on it. But, most people had no idea this was actually happening. It turns out, paradoxically, that this relationship is really, really critical because this is effectively the framing of what's called the Grossman-Stiglitz framework, which is the statement that people will always say that as the market becomes more passive, the opportunity set for the active managers should be growing. Perversely, it's 180 degrees in the opposite direction, because what is actually happening is you are losing demand for fundamental signal. Nobody cares. You can scream from the top of your lungs, earnings are going to be a miss. The CEO is sleeping with Martians, right? It really doesn't matter what you say. At the end of the day, the non-fundamental traders are the only ones that are actually attracting incremental capital, right? I'm actually working with a Utah-based professor, Davidson Heath, whose work used to be cited as a pushback on my own around passive. Davidson has completely abandoned that. He will actually tell everyone that he was wrong. I am right. That's why we're collaborating on some of this stuff. And the simple answer is that it actually turns out that there's a second type of information, which you just alluded to, which is flows, right? And what is actually happening is that information is being paid for by the Citadels, Millenniums, et cetera, of the world, who are all engaged in payment for order flow or various types of index arbitrage strategies, et cetera. They have become the dominant players, and all they care about is flow information. Look at your inbox. Look at the research you now receive from Goldman Sachs, Morgan Stanley, et cetera. It talks about ETF positioning and flows, not the fundamentals of companies. And so, if you introduce a beast in the form of passive that responds exclusively to flows, everybody else is eventually going to have to bend a knee to that. And that's what we're seeing in the research production and the information production.
So everything leads up to right now, the flows that we're seeing, what's happening. Have you ever seen anything like this in terms of a self-inflicted economic harm that's occurred here? Give me your current thoughts, because you know a lot of these players that are obviously involved in the market, and some of this, what you can talk about here.
I mean, the quick answer is that first, I just want to emphasize we do not have the counterfactual. So we do not know what a Harris administration would have done differently or how markets would have reacted. With that said, the Trump 2.0 administration very, very clearly believed in a blitzkrieg type strategy, right? Let's move fast. Let's catch our opponents off guard. Before they wake up, we're going to be deep into enemy territory, and we probably will have cut off their supply lines. That worked phenomenally well. Basically, the first 4 weeks, the Democrats and the opposition were basically just spinning their heads saying, what in the world is going on? The problem with the blitzkrieg strategy is the minute you slow down, if you find yourself behind enemy lines and you have not made sufficient progress in disabling your enemy, you suddenly are the one who now has extended supply lines. You're the one who is, no longer has home field advantage or the element of surprise. And things start to go haywire pretty quickly. And I think that's a big chunk of what we're seeing in the Trump administration right now. Now, what's also fascinating about this is I've used the language repeatedly that this is like a mini COVID. And, you remember this probably too painfully. Everybody who was actually following the news in markets knew that there was a respiratory virus on the loose in China in December of 2019. Right. We knew that it was hitting Italy in a big way by January of 2020. I'm sorry. And by February 2020, everyone's kind of sitting there like going, oh my gosh, like it's spreading in New York, and their grandma is keeling over, etc. And the markets kept going up. Why? Because nobody lost their jobs. Like what really killed people in 2020 was that kind of jagged drop and then recovery to new all-time highs in January. I would argue there's like a lot of similarities we've seen repeatedly over the last couple of months where people have pointed out that the economy is weakening. And until like literally Zelensky and the Europeans started pulling capital from US equity markets, we saw no response. Right? Like we knew the tariffs were coming. It's the same thing I've said about everything else. Like, did we suddenly discover that Trump was going to do tariffs? Hadn't he told us this was the most beautiful word? Right? The markets have lost their capacity to think in a forward-looking basis, in large part because the dominant feature is flows. Do I have a job? If so, then buy. My employer will continue to contribute. All of these things play out in markets that largely don't reflect underlying fundamentals. And I think people have been super confused by that.
But one second, Michael, on that, because when you say people were expecting it, people were not expecting a poster board with numbers that were made up, literally, that came out from a wrong equation, an erroneous equation, right? I won't go into that again. I've talked about it enough. But you take a bad fraction and then you divide it by 2, and that's your number, to your point. Porter Collins was on a podcast with me recently, and he made a comment. Someone was trying to compare it to COVID, but he made a great comment. It's Brexit. It feels like a Brexit situation where you're trying to figure out what is your standing in the world economically and the world order and that change. So I don't think it's as easy as you're saying it was over tariffs. So tell me a little bit about the math, because you're a math guy. I'm not going to let you get away from that and how this was constructed. And your friend, Scott Bessent, seemed to have no idea how these numbers were constructed or what the actual rates were going to be 15 minutes after they were presented. So tell me about that.
Yeah, no, I mean, I am not going to defend the apparent ineptitude in terms of presenting the materials. I would highlight that there was very clearly a plan, that there had very clearly been strategic thought that was put into this. We knew about these plans back in 2018. We knew about them in the summer of 2024. We should have understood what was underway. What appears to have happened at the very end is that Trump demanded the biggest and bestest tariffs, and required some type of formula that explained why this happened in a systematic way, so it didn't appear completely arbitrary. And the formula, by the way, actually was not an error, right? That is the actual correct number for a single period rebalancing of the trade deficit, strictly using the goods, right? Now, that's absurd. It is bad economics, it is bad math, it is bad politics to present something that extreme. But I think by and large, the idea was, well, let's just put any rationale out there that we possibly can, because they're just going to come to us. There's a totally forgotten Kevin Bacon movie, so we can use the 6 degrees of Kevin Bacon now, but called Quicksilver, in which he was an options trader on the Pacific Stock Exchange. And he thought that he had actually cornered a position in the options market, lost all his money. But I'll never forget the scene in which he's like, all right, where's my buyers? And nobody shows up, right? It's a little bit like the Trump negotiations. Where's everybody dropping to the knee? Anytime now, they've got, these are the best knees, right? Come see our knees, right? It just was badly executed, really badly executed. Now, with that said, does that mean it goes straight down 1929 style? I'm very skeptical. Even 1929 didn't go straight down 1929 style.
Yeah, well, that's fair. I just think that we just got through the supply chain issues from COVID, fixing those things. Yes, we didn't reshore a lot of jobs during that time period, but we fixed things. And now you're basically freezing the economy. And
Yep.
I won't go into all the shipping and containers and stuff that's just waiting. We know what's going to happen to those rates when things do free back up and they come to some deal. They're going to be astronomical. So inflation and higher costs are making their way here one way or another. But it's really interesting when you have a dollar going down, rates going up, everything's gone opposite on how they would have perceived it. They're messing around, again, back to math, with $37 trillion in debt and a deficit that runs at 7% GDP. You can cut all you want from these Doge guys in government. It's not going to make a dent because you're probably cutting revenue on the back end with, in the private markets at the same time, consulting, et cetera, there. So talk to me a little bit about that in terms of, because of where we are in a debt to GDP perspective, why this is so much more dangerous than it would have been, say, 30 years ago.
Well, I think that there's a couple of things that are really critical there. One is I very much am in the camp that says we got to be very careful comparing a household or corporate balance sheet to a government balance sheet. We owe money in the equivalent of Danny bucks, right? Danny can theoretically print as many of them as he wants. Therefore, there is no binding constraint. Now, everyone's screaming at the screen right now, MMT, and he's a wacko communist, et cetera. No, that's just a statement as to how the system actually works. So the idea of going bust in nominal terms is just not there, right? Now, what is real is that debt and that currency that we use, that we call effectively the money supply of the United States, is really more the equity of the United States. It's how diluted does everything become. And so when you have $37 trillion worth of debt outstanding against a roughly $27 trillion economy, 28 trillion, what you're actually saying is that there's a whole lot of cash out there that wants to be spent in the future that we are currently locking up in very short-term instruments. And if people decide that they don't want to take those instruments because they are concerned that we are going to be bad stewards of that equity, then they can convert that into immediate spending power that shows up as an outward shift in aggregate demand and causes, of course, prices to rise in a way that damages the value of that equity. That's the key risk, right? Our key risk is always that we are going to badly spend the money, that we're not going to invest it properly. And as you point out, 25 years ago, like, there was at least a hope. There was at least an element of a brighter light on the horizon. We remember the compassionate conservatism. We remember the hopeful enthusiasm for the internet, that this was going to unite humanity and it was going to lead to insane productivity. And I'm sure you even remember ridiculous companies like VerticalNet and Purchase Pro, et cetera, that were going to introduce incredible efficiencies, just like we talk about with AI today. The really key difference, that was all about hope. The world is going to be a better place. AI is like this reluctant, investment scheme where, well, we're going to keep spending it because if we don't, then the Chinese AI will destroy us before our own AI will destroy us. There's really not much enthusiasm going on right now. right? And I just think people are really depressed and really disappointed with how we've chosen to spend our resources. And ironically, that actually makes me oddly more bullish today than probably 25 years ago.
More bullish in what capacity?
I think we're closer to reality, right? I think we're closer to recognizing how badly we have guided our children, how badly we have guided our society, that in the name of some attempt to return to the 1950s, that we are treating a segment of our population with incredible anger and vitriol and hatred, that is super unproductive relative to human capital formation. I think the exact opposite was happening towards a totally different group 2 years ago, right? Where we were suddenly deciding that, you know, those who had benefited from a power hierarchy, and I'm using intentionally inflammatory language to highlight how absurd it all is, right? That they should be discriminated against, right? At the end of the day, the answer is always discrimination is bad, and it lowers outcomes and it lowers the potential. And people are really frustrated and angry, and they don't want to hear that message right now.
It's fair. And then as it relates to Jerome Powell, who is upset because Trump ruined his soft landing, as we see it here today, at any moment we could hear something more about Trump's disdain for him. But it's clear to me that whether it's now or a year from now, I think it'll be sooner than that we're going to start seeing rate cuts potentially, and potentially QE5, right? Where we go back out, print money, and start trying to control the longer end of the curve. To your point, in this type of situation, in this environment, the market's already telling you through gold, through crypto, and through rates that they're not going to stand for that actually cutting rates would be inflationary, that if you try to print money to buy treasuries, they'll be more focused on more debt that you'll end up having on the balance sheet as a result. So talk a little about that and how we get out of this mess, because we have forgotten every crisis, or the self-inflicted crisis that keeps coming up. We were already dealing with things that were going to be somewhat of a challenge, and it feels like it's just compounding on itself.
Well, again, I'm always reminded of the Adam Smith line, there's a lot of ruin in a nation, right? There's a lot of things we can screw up when you've got 350 million largely productive individuals who are all rowing a boat in a somewhat similar direction. It's that rowing a boat in a similar direction that I think is really the hardest part for us right now, because we're angry and we're frustrated and we feel that our hopes and dreams were not achieved, and it's easier to lash out at other people. We will unquestionably have another bailout, because if you properly frame sovereign debt as equity, right, effectively what is been issued in order to bring forward the capacity of harnessing the resources that we have in terms of people, land, technology, etc. The real challenge that you create for yourself is basically saying, did the private sector take on things or do things in expectation of how things are going to work out in the future that can't be met? And this is where my passive stuff becomes really important, right? If people have invested for their retirement in the stock market, in the process driving valuations higher because of the influence of passive investing, that then means that there's actually far less capital out there than people think to fund their retirement, right? That means that spending could fall significantly, which means government revenues could fall, which means the ability to service that debt or create that income is lower going forward. Likewise, it becomes a question of, did the private sector expend a whole bunch of stuff sending false signals because the government suppressed signals from the credit markets? Absolutely. This is the thing I'm most concerned about right now, is in the aftermath of the COVID pandemic, the government engaged in all sorts of fraudulent activity to prevent fair clearing and fair information creation and credit. The critical thing to remember about capitalism is price is the mechanism of information exchange in a capital economy, right? If I know the correct information, I can influence the price in the right way. But if the government suppresses that information and lies to me about what's happening, it becomes harder and harder to properly price stuff. That means I can extend credit when I shouldn't. It means also that credit can be withdrawn rapidly and artificially when suddenly that information starts to be revealed. Now that's happening. Student loans are here. FHA loans are starting to go, we're aware that they've been going bad for an extended period of time. That's coming back on. The combination of a tariff, which is a tax, student loan repayment, which since it's going to the government and payments to the private sector were already guaranteed, those payments to the government are just another tax. And now all of a sudden you're talking about various other forms of taxes in the United States with tax reform, quote unquote, right? This is going to theoretically raise the burdens on the working class in the United States. Like, people can only take so much, right? And while it may feel like, we've elected this libertarian candidate who is ostensibly going to lower our tax burden, the proof of what's actually happening is the opposite. We are radically increasing our tax burden, and the middle class is starting to buckle.
It is amazing how efficient the markets are in telling us actually what's happening versus what we're hearing and being told. So the role of Bitcoin and or gold is part of what the market's telling us. I'd love to get your thoughts there. And then I also want to step further into the role of AI and what that impact could be on the economy.
Well, so Bitcoin, I'm a noted critic of. I'll lay it out very, very simply. Bitcoin is a program that is being run very similar to a worm virus. The white paper provides us with all the information that we need to know about how it is actually developed over time. We have some modest forks that have changed things and dealt with various error corrections, but the underlying system has not changed in a very meaningful way. That actually means that we can actually build a program that simulates it and runs it forward. And the problem is that when you do that, you discover that a truly hard capped currency, as we're describing, can never be used for transactions because the risk of loss during a transaction, even if marginally positive, right? Like, it can't be negative. You can't have negative loss potential on a transaction. If it is non-zero, that closed system ultimately has a far higher cost of capital than any other system, and it coalesces eventually to a single holder. It is a system built for wealth extraction and concentration. It is not a tool that can be used by the median household to protect themselves against the depredations of government and central bankers. It can be subsidized for that use by Western investors in a certain period of time, and it can be used in El Salvador, or it can be used in Lebanon in their banking system as an adjunct, but the central feature of it, unfortunately, is consolidation of wealth and power. And I encourage you, by the way, to actually type into any form of LLM, apply a POSIWID framework to Bitcoin. POSIWID stands for the purpose of a system is what it does. It's a theoretical framework that was introduced by Stafford Beers in systems dynamics programming. The purpose of something is what it actually does, not what people say it is, right? So I can tell you Bitcoin's all about democratization, et cetera. If you plug the exact same question in for gold, you get a very different answer, because gold has certain characteristics that Bitcoin doesn't. Gold actually responds to human innovation. If the price of gold goes higher, then we can actually increase production through additional mining tools, through better technological application, et cetera. You can't do that in Bitcoin. The fixed release schedule of Bitcoin does not actually reward innovation. You can't speed up or increase the fraction of Bitcoin regardless of the price of Bitcoin. That actually means that the price of money rises relative to everything else in Bitcoin, and you end up with a fantastically deflationary system. Credit is a mechanism that allows people to access debt or access money before they have actually had the capacity to earn it all in advance and save it. It is a tool for the young to access capital before the old are willing to give it to them. And you can't have a debt-based system. You can't have a role for debt in a deflationary currency. It's harder to pay back debt in the future than it is otherwise. So everything about Bitcoin is actually bad for young people, except for the excitement of thumbing their nose at old people. Interestingly enough, gold, if you run it in the exact same framework and you evaluate what it does, has historically worked because it is an element. It's not magic money. It's not money itself. If you pull up the periodic table and look at the elements surrounding gold, every element next to it has functioned as money: silver, copper, tin, nickel, etc. They all have functioned as money. There's nothing magical about it. It's just in finite supply, and it's really hard to get. And as a result, it proves to be a tool that you can use for briefly exiting the system. So what people are saying very clearly right now is, get me out of here. Some of them are going to Bitcoin. I think that's a mistake. And some of them are going to gold. And that means that the price of gold can only go higher as long as more people are voting for that. It's hard to see a scenario in which trust suddenly comes back and people are like, yeah, I'm going to really sign up for this Trump thing dump all my gold.
I'd love to hear your thoughts on artificial intelligence and AI and its role, because I'm not sure the angle that you're taking on it as far as how it's going to fit into the economy and take jobs away or make us more efficient, or both.
So I think the answer, unfortunately, is very much both. The way that I describe LLMs is that they're a universal interpreter for human machine discussion. If I go back 500 years ago and I'm in the United States, or what became the United States, I'm in North America, and you'd ask me what the single greatest skill that you could have is, I would say it's you speak Indian, right? North American Indian. That meant you had access to resources and understanding of things that the average person coming over had no capacity for. If you went 100 years later and you asked what was the greatest resource you could have, is probably knowing, being big and strong and knowing how to farm. If you went 100 years after that, it was some form of education that allowed you to manage a team in an industrial setting. If you went 100 years after that, it, interestingly enough, reverted to being able to speak a foreign language, this time computer, because we were moving into a new world in which a virtual space could inhabit us alongside our historical analog space, what we call meat space. The explorers in that new world were computer programmers. Now suddenly everybody speaks that same language, right? It's the equivalent of, the French politician observing that the great tragedy of the 19th century was that the new world spoke English, right? All of a sudden, the computers speak English. And that means that if you can properly and thoughtfully frame questions, the world is suddenly your oyster. That's a magnification talent for some people. It is an extraordinary tool for education. It is an extraordinary tool for providing services in digital frameworks. It's going to be very painful as an adjustment process, in the same way that the transition from the farm to the industrial world and city centers was traumatic and painful for those who were forced to make those transitions.
So I had the writer Michael Lewis on a couple months ago on
I
the
listened to it.
podcast,
It's great.
and now I have another writer, Michael Green. You're writing a book. Can you tell us a little bit about what that is?
Sure. So the book is titled The Greatest Story Ever Sold, and it's actually about much of what we were discussing, the impact of passive investing on markets. A lot of it is focused on trying to first identify what has happened, why it is occurring, and is there anything we can do to fix it. And then the more interesting stuff is actually the implications from a societal framework, right? We tend to take things like the market going up as indicative of truth and somehow conveying merit, right? Elon Musk is really wealthy because he's a meritorious individual, or holders of Apple are very wealthy because they were meritorious individuals. We see this most explicitly in Bitcoin, right? They are self-lauding in terms of their time preference characteristics, basically patting themselves on the back for winning a marshmallow test. That's not actually true. None of it's actually true. And so it has created a caustic framework in a lot of ways that is exemplified by a book that came out a couple of years ago called The Tyranny of Merit. There's a couple of other books that are coming out on this subject. And it's, led me to a staggering realization, right? Since we're talking about movies, anytime you're involved, one of my other favorite movies alongside The Big Short, I think Big Short's a better book, by the way. You're much more handsome in the book.
Yeah.
Is Good Will Hunting, right? And look, I'm a smart guy. It's clear that my head is larger than it should be, as is my lack of humility. But we all fantasize when we watch that movie Good Will Hunting that we're Will, right? That we're the protagonist. That's why we like it when he goes in the bar and he talks badly, and dismissively to the first year grad student. The simple reality, Danny, is almost anyone in our industry is a first year grad student. And so I very humbly am recognizing that I am following exactly Will's path. You said I have a 30-year, history in the market. Well, I'm the first year grad student who now 30 years later is doing some original thinking on his own. And I'm recognizing that I, dropped 150,000 on something I could have gotten for $1.50 in late fees at the public library. My insights are not, particularly novel, but it is really interesting to come at it from the perspective of a practitioner for 30 years and apply a framework that says, what have we wrought? And realize that it's not good.
How about them apples? So, Michael, in addition to that, obviously we can find you on Exit. Prof Plum, short for Professor Plum 99, PORFPLUM 99. You also on Substack, right? Yes, I give a fig.com. Ironically, that's Fig is one of the products you manage. I think it's Simplify, and on the Simplify Asset website. So, Mike, thanks so much for coming on. I can't wait to read the book and have you back on here soon.
Thank you. I can't wait to finish the book. I've sent off an early draft, but there's a lot of work left to do. So hopefully we get it out quickly. Danny, thank you so much for having me. I really enjoyed it.